All right. Welcome back, everyone, to the Binance Theatre. I'm stoked to be joining you again. This is a really fun little session inspired by the Breakpoint conference that Solana held earlier in the year. Rather than giving you guys panels and hearing the same old opinions, we want to give you a debate and let the boys get a little bit spicy. So we've got tax versus gains for you here today. What is the most important thing for you to know, understand, and keep in mind when you are managing your crypto portfolio? Is it the trading strategy that you use, or is it how you set up and consider tax implications as a part of your portfolio management? On our red team today for the trading strategy guys, we have James QK and Adam Stokes. And on the tax side of things, we have Patty from Crypto Tax Calculator and Matt from Crypto Tax Sucks. But you'll be arguing that crypto tax doesn't suck today, which is kind of funny. Let's go along, guys. Do you want to give yourself a really brief introduction first and talk about where you are and what you guys do for a day job?
Hi, I'm Patrick. I work at Crypto Tax Calculator as a product manager. I've been there for 3 years now, and I do a lot of degenning on the side, so I can make sure that we've got all the integrations to support your degeneracy on chain. And yeah, keen to crush these guys today.
I'm Matt from Crypto Tax Made Easy, and our business, sorry Patty, but crypto tax software isn't perfectly automated. It brings a bunch of data in, helps structure some of that data, but there's a human that needs to review it. So I have a team of accountants that reviews that data, reconciles it, makes sure the reports are accurate so that you can give it to your tax agent and should be able to file your tax. No worries, the ATO shouldn't be coming back and slapping you. Live up on the sunny coast. You can probably guess I surf a whole bunch, and a bit of a degen myself. Spend some time staring at charts.
Afternoon, everyone. I'm Adam Stokes. Do we have any Stokesikins here? I founded the Crypto.land, also a YouTuber. I've come up here to explain why tax shouldn't be your first focus, but profits. I'll school these guys on how it's done, but at the end of the day, thank you all for joining us.
Hi, everyone. My name's James, and I head up marketing for Binance Australia and New Zealand. Super stoked to be up here today to argue the counterpoint to tax. The amount of events and conferences I've been to, seeing these guys harp on about tax and how it's important, it's given me a lot of ammunition for why we're focused too far that way and not enough on why we're here in the first place.
And that's where the inspiration for the panel came from. James and I were talking about what we should do the session about, because this panel is a part of our Binance Beach weekly podcast episode. We run it on YouTube, and we've had these guys and other guests on. I said, James, what do you reckon we should get the guys up to talk about? And he said, I'm sick of tax guys talking about tax. I've had enough of it. So let's let him at it. Trading strategy. Do you guys want to open with opening statement? Why are profits most important?
Ladies and gentlemen, in Australia, we are so focused on negative gearing. We are so focused on the tax man. And in many instances, that scares us away from making money. At the end of the day, although tax is certain, profits are not. Therefore, your focus must first be on profits before minimizing any tax. In a simple analogy, I give you this. It's much better to pay 50% tax on $1 million profit than 0% tax on no profit. Therefore, ladies and gentlemen, my crypto brothers and sisters, profit is always first.
Tax guys, first retort.
I actually agree with you, Adam. In Australia, our maximum tax rate is 45%. So if you earn $1, you get to keep at least 55 cents of that. So profit is profit. That's why my argument today is not that crypto tax is more important per se, but rather that trading strategy is a fool's errand. Most traders lose money. About 62% of meme coin traders on Photon, which is a popular meme coin trading platform, lost money. 79% of actively managed mutual funds underperformed the S&P 500. So if you're trying to actively trade, I think at most you might get a few percentage points better than if you just DCA'd and held if you are very skilled. But unfortunately, most of us, myself included, are not very skilled. But some of us can get lucky. If you have 100 people flipping a coin 5 times, 3 of them are going to get heads every time. And they're probably going to write a book about how to flip heads every time. So my argument here is that trading is a fool's errand, and tax strategies help you whether you make money or lose money. It applies to everybody. Trading, not so much.
Continue, guys.
Okay. Good point, Matt. Good point, well made. So from my perspective, trading strategies falls into a number of different areas, right? There's no one strategy for how to grow wealth over the long term in crypto. We obviously know it's a highly volatile space and a growing space at that. And so you have to take an interest in the market, you have to take an interest in what's happening, you have to understand the various subsectors within crypto. You know, we've had discussions today on gaming, on deepin, decentralized physical infrastructure. We've had a whole bunch of conversations on these different areas. And I say, when it comes to trading strategies, you know, we're not just talking about whether you're doing technical analysis, dollar cost averaging over the long term. Like, you have to really understand the whole marketplace. And that is where I'd suggest most people spend most of their time and attention. Like I said, this is a very fast-moving space, and there's a lot to learn. And spending more time understanding where the puck's going and what the emerging trends are is, I think, time better spent than worrying about optimizing your tax portfolio or tax liability.
To stay on top of like the changing metas and like what's going on in crypto, like every day, if you're actively trading, you basically need to make it your full-time job. So, like, I know that's not a reality that's possible for most people, and you know, with the explosion of meme coins that has happened over the past year, there's literally new coins, thousands of new coins actually getting launched every day. And if your trading strategy involves trying to time or pick any of those different coins and make money off it, the probability is that you're going to fall into the 99% of people who lose money trading. So the argument that spending more time on your trading strategy doesn't really make sense from a probability standpoint, unless you can force yourself to be in that 1%, which means probably quitting a job and not sleeping anymore, so that you can stare at deck screener charts all day and make sure that you can extract as much profit as possible. What is actually certain is taxes, and there is also certainty in being able to improve your tax outcome as well. There's existing frameworks that are well known. You go to someone like Matt, and he can basically undoubtedly help you save on tax. So yeah, tax is applicable to everyone. Trading strategy is not, as you can see by the numbers. I mean, with Pump.Fun, if you look at addresses that have interacted with any Pump.Fun tokens this year, I think over the last 6 months, around 90% of them have lost money. About 7% are flat, and the rest, I think there's 2% that made about $100, and then only the 1% has actually made a substantial amount of money, so something like over $1,000. So if you think about it from a probability standpoint, the probability that you can save money by focusing on your tax strategy, investing in someone, going to someone like Matt, is like almost 100%, I would say, like very high. The probability that focusing on your trading strategy, that will give you more money, the probability of that working is about 1%. So if you look at the numbers that way, it's pretty obvious what you should be focusing on.
Gather round, kids. It's story time with Uncle Adam. Many years ago, I was coaching a young female colleague, shall we say, about crypto. I spent a lot of time with this person explaining the profits that she could face if she got into the market early. We went through all the mechanics of crypto, and this was back in 2017. Many years later, I saw this young lady and I said, "Congratulations, you're rich." And she said, "No, I didn't buy any." I said, "Why?" She said, "Because I didn't want to pay tax." She forewent all those profits, potentially millions of dollars in profits, because she didn't want to pay tax. And I see this happen over and over again. If the focus is first on tax, you avoid the possibility of making the profits. The second part to this story is, let's talk about the 12-month situation that we all face. An old law that I think we should outlaw, so to speak, where if you hold an asset for more than 12 months, you pay tax on half of the profits. If you hold the asset for less than 12 months, you pay tax on all of the profits. Noting the velocity of the crypto markets, this can really mess with how we buy and sell crypto, particularly the selling of the crypto. Many of us have been in a situation that we're holding a crypto and it goes to the 11-month mark and we're just about to press sell. But we say, hang on a second, if we don't press sell and we can make it another 30 days, then I only have to pay tax on half the profits. Well, of course, what happens in those next 30 days? The crypto crashes, you were focused on the tax, you lost all the profits, so congratulations, you now pay profits on 12 cents as opposed to tax on $12 million.
Well, that was a cute anecdote about the lady who didn't buy. But if she had actually looked into her tax strategies, she most likely would have bought, because a professional would have helped her realize that a dollar earned is a dollar earned, and we can help you minimize how much you pay in tax. So that was a bit of a straw man argument right there. However, I do definitely agree with the latter fact. I often see people posting, here's tax tips for how you can save on capital gains, and one of the first things on that list is always, if you hold for 12 months, you only pay half the tax. And that's a terrible trading strategy, as Adam pointed out. So I 100% agree with that. But I think when it comes down to it, any competent tax advisor is probably going to have some better strategies that involve the correct entity selection and structuring. And I think Patty will probably talk about it in a little bit, but there are some examples of where maybe a good trading strategy in the short term can really screw you in the long term.
Yeah, interesting points. I think Paddy raised some interesting stats there about how many people actually make money in crypto. Can I just get a show of hands? Who here has made a profit, or who here, when they did their taxes, should I say, for the last financial year, realized a profit in their holdings?
Hands up.
Okay, so I'd say probably, 25% of the
I'd call that 30.
30%?
Fair 30.
Yeah, so, there was a Bitcoin all-time high back in March, and obviously we've been on a run since in the last few weeks as well, so hopefully next year we'll have more profits to declare. But 20 to 30% of people have realized a profit. And so therefore, for your businesses, only 20 to 30% of the target market is your service applicable to. And I'd counter, Paddy. I'd say that suggests there's even more need for research and trading knowledge to understand how better to position your portfolio to make sure it's appreciating and accumulating in value no matter what the market conditions. Over to you.
A few things here. First of all, I think it's disrespectful that you think the attendees of Australia CryptoCon fall into the rest of the bucket of everyone losing money. So, just saying, of course the attendees are making profits
Small
here.
sample size.
Yeah, exactly.
High quality. I take your point.
Yes, yeah.
A good-looking, highly intelligent audience, I must say. Remember that when it comes to the voting later.
We are
Objection
getting you guys
pandering.
to vote for a winner. So we will come to that at the end. Make up your mind as we go. But over to you, Paddy.
Yeah, I mean, on the point as well about, you know, people having to focus on trading and you know, like us only being able to help people who have made money as well, that's completely not true. So, you know, like tax applies to everyone, whether you've made money in crypto or not. So it is something you should be thinking about no matter what you're doing, no matter if you've realized profits or not, whether you've realized losses or not, what you've done, there's always something that you can do to prepare for in the future. Because in reality, if you're investing in crypto, you're doing it to make money, right? Well, I hope so anyway. Or maybe you're investing in it for the tech, but I don't really believe you if you're saying that. I mean, another point I want to make is that in crypto, it's like extremely unique in that a lot of crypto trading is crypto to crypto. And crypto to crypto, a lot of people still don't know this, but crypto to crypto trades are taxable. So you can potentially realize a capital gain at that point. And even though you're realizing a capital gain and you're trading one crypto for another, you're never actually seeing any Australian dollars, except you are getting taxed in Australian dollars. So if you've got a trading strategy that involves a lot of, you know, short-term flips, you're flipping from one coin to another and trading directly from one crypto to another crypto to another crypto, realizing profits along the way, you can end up in a situation where you have a huge tax bill built up throughout the year and basically no Australian dollars to show for it. Now that could be perfectly fine if the tokens that you're holding retain their value and you can sell them to pay off your tax bill. But if your trading strategy carries on, you go through the whole year and you make one final last trade on June 29th, you turn one crypto into another, realize a nice profit, and then on July 1st, the new crypto that you bought, the trade goes a bit south and you lose everything, goes to zero. Well, the ATO isn't going to consider that a loss in the previous tax year. They're still going to look at your trading profits for the past tax year, and you have now no Australian dollars to show for it. So you're going to have to pay out of your own pocket to cover the tax bill. So you could actually be in a situation where your trading strategy is not only, you know, a bad trade gone wrong and you've lost your portfolio, you now actually have to pay out of pocket extra money to cover your tax bill. So once again, focusing on tax strategy like it should be the focus, because you can actually get put in a much worse position by just disregarding it completely. And again, if you're looking at the probability, the probability is that if you focus on trading, you will lose money.
So let's be clear here. God, I sound like Harris, don't I? We want to focus on making money. We come for the Lambo, we stay for the revolution. Congratulations to everyone who's in profits this week. Hopefully we'll see that 100K mark crossed during the conference. You have earned the profits that are coming your way or that you've already got. Had you focused purely on minimizing tax, you could have foregone the profits that come. The biggest expense, the biggest liability in my life is tax. We're not saying that you shouldn't know the tax rules. You've got to know the tax rules and you've got to play by the rules. If you can minimize the tax, fantastic. but that's not your focus. Don't run towards minimum profits by minimizing tax. Run towards maximum profits, knowing the rules of tax. Once you get to a situation where you're earning 7, 8, potentially this cycle, some of us 9 figures, wouldn't that be lovely? You've got enough money to choose what tax jurisdiction you're in. You've got the options to choose to go where your money is treated best. But if you have focused purely on minimizing your tax, you're probably equally minimizing your profits. Head straight towards those sick, eye-melting, face-melting profits, eye-watering profits, and then you can figure out how you're going to pay the tax bill, knowing the whole time you are going to pay tax. It's a certainty. But trust me, once you start getting to 7 and 8 figures, you're not looking at the tax calculator software, although if you want to use that software, use my link for a 35% discount. You're looking at what nation to live in. Where am I going to go to where my money's treated best? And when I'm sitting on millions and millions of dollars, I'm not worried about my 35% discount on the great taxware software. It is a very good software platform. I'm thinking about which nation can I get the biggest house with the most amount of maids that I can look after appropriately.
Just to address that point, you actually don't have that level of mobility. If you buy your crypto positions that go to 7, 8, 9 figures while you are an Australian tax resident, and you try to go to Dubai because you think you can go there and sell and pay no tax, I hate to break it to you, but Australia is going to hit you with an exit tax. Those assets, they're here. If you want to go to Dubai, you're going to have to pay, even if you don't sell that crypto when you move over there, you're going to have to pay as if you sold. So you're still going to get hit by Australian tax rates on those gains. So it would help to, before you go into any trading strategy, to first consider your tax strategy and your entity setup. Because to your point, you are right. You always want to run towards maximal profits. And there are certain ways that you can custody your crypto that may allow you to go directly towards maximal profits with your trading strategy and also be paying the least amount of tax on it. I'll just give the example for me. I'm lucky enough to be in a excuse me, high income tax bracket. And so any money that I earn from crypto is going to be taxed at a very high rate if I custody it personally. But if I custody it within a trading company where the corporate tax rate is capped at 25%, well, I can just go full out. And any of my short-term holdings or yield farming or any DeFi activities that would be considered income within that trading company, they're going to be capped at 25%. I can go for my life. I don't have to think, am I going to qualify for long-term capital gains discount or whatever? And that's actually, that tax strategy has allowed me to implement the optimal trading strategy. I say trading loosely because I don't really trade. Optimal investing strategy that has allowed me to ultimately grow my net worth the most. And if I did not consider that tax strategy, essentially for every $100,000 that I earn over the course of a cycle, excuse me, I'd be saving $20,000 in tax a year using the entity setup that I have versus custodying it personally. If I then put that $20,000 DCAing it into Bitcoin every 4 years over the course of a cycle, by the end of the cycle, I have an extra $150,000 in my pocket versus if I didn't. And that's just on if I made $100,000 a year. That's a huge return. So the rate of compounding that you can get by keeping more money in your pocket, if you do have a good investing or trading strategy, game changer.
Must be very nice to have a trust to realize tax breaks on all those profits you're making over there, Matt.
You should have focused on your tax strategy, James.
Wah, wah.
So my point is, to set up a trust, you have to know the tax system. You have to pay how much? A few grand?
There are definitely administrative costs to having a trust, but we're talking about 7, 8, 9 figure swingers. It doesn't matter. Pennies.
So what I'm saying is, and hopefully I'm not speaking for out of turn, but I expect a lot of people in the room are relatively new to the space, right? You're coming in, you want to get educated on the various different aspects and different sectors, and the last thing you're thinking about is forking out another couple of grand to set up a trust in the expectation or the hope that you'll make money and then save on that tax break. Now, don't get me wrong, like, it must be very nice to be in it for a while and to be realizing those profits and to then want to optimize that. Fair play to you, Matt. But for me, as a beginner, or a beginner, a few years ago, it was coming in, learning as much as I could, and employing a trading strategy that I believe will work over the long term, and I can talk a bit about that, to hopefully realize some profits. And when I do, I fully expect to pay tax. But I'd be grateful to pay tax because I'll be paying tax on a profit. We're not getting around the fact that the tax system exists. There's only two certainties in life, death and taxes. We all know that. But my main priority coming into the space is to get that profit first, as Adam quite rightly pointed out. And just to counter one of Paddy's arguments that he seems to be peddling quite often about people not making money employing active trading strategies, that might be fine. Like, my trading strategy, as Matt mentioned, is to dollar cost average in over the long term. I don't know which coins are going to go up at any one time, but I believe in the industry. I believe in the direction of travel up and to the right. And so over the long term, I'm happy to dollar cost average in and hopefully realize some profits one day. And when I do, I'll happily pay taxes. But I think focusing on the taxes first would be to put the cart before the horse.
I just want to give a shout out to our hardcore supporters in the back here wearing the bright purple shirts. Absolute legends. Hell yeah. Yeah.
Distraction.
A few, I have to gather my thoughts. I think there's an important point to make here, and obviously we're arguing trading strategy, against tax strategy. It's not one or the other. And I think our point is that tax strategy should be your first thought, and then the trading strategy should be something that you focus on afterwards. Because if we are lucky enough to be realizing 7-8 figure gains, I hope so, this cycle, you don't want to be thinking about taxes at the top. That is like going to spell disaster for you. You want to be thinking about it now, or ideally yesterday, so that when it does come time to lock in those juicy profits and change your life, you're not going to get whacked with an unnecessarily high tax bill. If in 6 to 12 months' time we're looking at 250K Bitcoin, you're going to be kicking yourself if you didn't reach out to a tax professional and ask, hey, what could I do to maybe improve my tax situation if I was to make profits? So taxes first, trading strategy second, and also, James, I'll get you on a technicality here, I think. You're talking about DCAing into crypto. So that's just, fiat into crypto. That's just buying. That's not trading. So we're talking about trading strategy here. You're an investor, and I'm not sure why you're on the trading panel.
Look, the reality is we're all mates up here, and I think we could all comfortably debate either side. We were quite happy to sit on either side of this debate. So at a starting point, we're all in this together, and well done again to everyone who's seeing the profits. It's a good day. It's going to be a good year. You've earned the profits that are coming your way. The tax would have meant nothing if you didn't step up to the plate and have a go to earn these profits. Go for the profits, knowing the rules of tax. We can't avoid the tax. And you raise a good point. If we exit the country with a liability in tax, you're going to have to pay it anyway. But the best story time with Uncle Adam, every now and then, my accountant gives me a call. And I'm now at the point that as soon as I see my accountant call, all I do is I say, how much? I don't even say hello. My advice to all of you is get a very good relationship with your accountant. If you have an accountant who doesn't believe in tax, sack him, doesn't believe in crypto, my apologies, sack him straight away. Any accountant who doesn't believe in crypto, sack him and get a new one. But going back to my accountant, he rings me up and I say, how much? And he says a number that always makes me cry. And he's just saying, I've got to pay the tax man something. But he always finishes off the conversation with this one statement every time. He says, Adam, there are worse problems to have than making so much profit that you have a massive tax bill.
I'd like to meet the accountant that doesn't believe in tax. I'd like to see that guy.
Me too. Be a unicorn. There's not much to respond to there. You agree with our point. So that means we won, right? No, I definitely agree. I could have been on that side of the debate as well. Made a strong argument. I think they had the high ground. So I think I'll just turn it over to Liam to see if there's anything you wanted to throw us under the bus with.
Well, there's one thing that maybe we haven't considered as much. I think a lot of the discussion's focused around crypto to crypto trading. What about on staking or DeFi yield kind of products? Should you be thinking about yields or should you be thinking about tax? Should you even consider those products or should you just hold to avoid tax? What's more important outside of just, swapping or converting?
Yeah, great question, and very relevant in Australia. So not only can you trigger capital gains tax in Australia with crypto, you can also trigger income tax. And the ATO is a bit sneaky with its rules around income tax, and I've seen a lot of people get seriously burned by things like airdrops, yield farming, and staking. So these things, depending on the types of airdrop farming that you're doing, so like the initial token generation event, when you first claim the tokens, the ATO's released some guidance that says that's not income, but any subsequent airdrops of tokens that have previously been trading, that's going to be an income tax event. So the market value of those tokens when they hit your wallet is treated as income, it's taxed as income. Same thing with staking rewards, same thing with yield farming DeFi tokens, any sort of on-chain degeneracy that you're doing, interest, all that sort of stuff. And with crypto, typically you're getting paid in volatile tokens. So on the day, airdrop day, there's a lot of hype. Often the tokens launch at some ridiculous valuation. You claim it into your wallet, maybe you've really hit gold and got $10,000 worth of tokens hitting your wallet. That's their market value at the time that you receive them, and that's what you have to pay income tax on. But you're a diamond hander, and you hold on to them. And throughout the year, those tokens go down in value, and now, just before the end of tax time, they're worth $1,000. So what you do? You go, oh well, I'll sell them, get the $1,000, and I'll realize that loss. What you've done in this situation is you've got $1,000 in your pocket, you've realized a nice $9,000 capital loss, but you still have to pay tax on that $10,000 of income. So now you're in a situation where, depending on your tax rate, you could actually, highly likely, pay more tax than you actually made from the airdrop. And I've seen this was really bad actually in the past cycle with Wonderland Time and all the ohm forks. So I'm not sure if many of you were around for that, but there were some protocols producing like 100,000 APY. People were like printing millions of dollars a day. And within a couple of weeks that exploded. And those people who had literally made, hundreds of thousands of dollars in income every day for 2 weeks, suddenly were left with zero. And they thought, oh, okay, it's all good, I'll just use my capital loss to offset that income. But in Australia, that's not how it works. And they still had to pay tax on the income that they made in those tokens. And you can see how that can turn into a really, really bad situation.
Great points made by Paddy there, but it's all very doom and gloom, kind of scary when you think. It almost put you off trying out crypto or trying out these new protocols in the first place. And as someone that's constantly trying to learn and keep up with what's happening, I'd encourage everyone to go on chain, to try out these new protocols, to receive airdrops, and test out these different DeFi exchanges. And then if you do realize a profit, or if you are gifted an airdrop, and then try and understand the tax liability. I will say to Paddy though, it is a minefield out there when it does come to some of these more complex swapping arrangements and staking. And I do think, we could be arguing on both sides of the house here. I do think tax software does help you kind of unpick a lot of that. So fair play there. You have helped me out. I do trade, not just dog-dash averaging. But my main point is, and it goes back to the original point that Adam's reinforced so well, don't lose sight of the fact that we want to test these things and we want to be trying to raise the top end and minimize the bottom end at both sides at the same time. But the focus should be on trying these things, trying to grow our portfolios, and be more positive and proactive rather than reactive, because it might put you off getting involved in the first place.
Sounds like James is looking for exit liquidity in the crowd.
Let's do a closing statement from both teams, and then we'll ask you guys to vote for the winner. Who wants to go first? Who wants to make a closing statement? Tax guys, why don't you write a reply there? I'll give you 90 seconds.
Closing argument is very similar to the opening argument. As we've seen here, active trading is most likely going to lead towards losses. And if you're making losses, actually having a good tax strategy in place, you can utilize those losses to potentially offset gains in other places. With the right entity structure, that loss could potentially offset income. As Paddy just mentioned, if you're doing DeFi activities in a trading company, well, the loss actually can offset that income. So if you do have the right strategy in place for the trading strategy that you want to implement, you could save your ass. And so I do think that first and foremost, thinking about your tax strategy is going to be incredibly important. And that's going to allow you to just go, as Adam said, and just go for every dollar, go for profit. So we're first, they're second, both equally important on some level, but I think we won.
Look, I will just backtrack a little bit and say in Australia, the staking rewards, the way they tax us, I think it's terrible. I think no matter which side of this table you sit on, the fact that we have to pay tax on an asset the day that it's dropped to us, and we may not even know that it's dropped to us, we pay tax on the day that it was given to us in fiat, even though that asset could go down. I think as Australians, we really need to review that. We need to make it more friendly. But in my closing statements, I reiterate, it doesn't matter how good your tax strategy is. It doesn't matter how well you've structured your trading strategy. If you're not making profits, it doesn't mean anything. Profits first, tax always. You have to focus on those profits, run towards the profits, understanding the rules of the game. Again, it is far better paying 50% tax on $1 million profit than a 0% tax on zero profit.
All right. You guys have heard the arguments on both sides. You guys did a great job. I think there was some compelling stuff on both teams. I'm going to ask you guys to vote now, and let's decide who has won this debate. Let's start with a raise of hands for James and Adam. Who thinks trading strategy is most important? That's a pretty good raise of hands. And who thinks tax strategy won the debate? That's pretty close, but I think I have to give it to trading strategy by a narrow margin.
You guys missed out because I said if we won, I'd buy coffee for everybody. So
You're all now blocked
wrecked
from
yourself.
that service. So obviously, guys, this session was a part of our regular Binance Beach weekly Aussie crypto briefing. We run that every week on a Friday on YouTube. It's usually about a 20-minute session where we talk with an industry expert like these awesome guys we have on stage. And we talk about the current market, the state of Australia, what's going on domestically. So please tune in, check that out, and we'd love to hear your suggestions for guests, improvement, and feedback. But we'll wrap it up there, guys. Thank you so much for joining us. I hope you all learned something. Come and find us at the Binance booth.